So welcome my friends, this is Professor CA Rohit Shroff and I welcome you on behalf of GK Share classes. In this video, we are going to discuss RTP of November 2023 for CA final auditing. My friends, our discussion are going to be divided in three parts. Firstly, amendments. Second, the MCQs, and a third is going to be descriptive answers. My request is, what I would insist is, pause the video, read the question yourself, try to interpret what will be the answer, and then hear out my explanation or maybe the answer that is given in the RTP. Try to solve it on your own. When you try it, there is a possibility that few questions which are new, you may not be able to solve it in one single go. But when you apply your own brain, when you are involved in that question, you will be able to retain that and maybe write it in the exam. So try to solve the questions, pause the video, read while I'm reading. You can pause the video, read it yourself and analyze the answer, see the answer in my video, see the answer in the RTP and understand where you have gone wrong, and the points where you have gone wrong, mark it so you can revise it later on and you do not make the same mistakes again. So let us start with the discussion of first part, that is amendments. So my friends, a very good news that there are no amendments. And a lot of students would be like, sir, what, no amendments? There are so many pages here. My friends, institute, till the time they do not issue a new material, that is new module, they will keep on reprinting the old amendments. So same likewise has happened in case of auditing. This is the RTP for November 23. Let me show you a RTP for May 23. Let me show you RTP for May 2023. The amendments are the same. I mean, there is no amendment as compared to May 23. So for example, this is company audit in May 23. Let me use a different color pen. For example, let me use green color, your favorite color, so you'll realize that okay, this is different. Okay, in this case, this is the same. This is company audit, same, likewise, no change. Then company audit and corporate governance, if you can see, there are no points that are added. Exactly the points which are there in May 23 are as it is, where it is copy pasted here. So this is no new amendment. We have covered this during the lectures. All those students who have attended way earlier in the lectures, or maybe this is second, third, fourth attempt, then in that case you may have to revise these videos. All the students are currently with us. Your dashboard lectures are already updated. So for example, if it is a topic of peer review, the topic is already updated because there are a lot of amendments. So there is no separate amendment video. That particular chapter is completely updated. So you can go again and visit that particular chapter. In case if there is any issue, if your dashboard is not updated, get in touch with the admin team. But all those chapter which has amendment have been updated. So all the students who have been attending with the latest attempts, we have learned this new thing only. So no as such, no amendments for you, but all the old students who have studied with us earlier, we have updated the dashboard. So if you can compare May 23 and November 23, there are no amendments. So our part number 1, our discussion of amendments, there are no amendments. So let us begin with part 2, that is question and answers. Moving ahead with the integrated case study. So let us read it. Rainbow, a non-bank limited, that is a systematically important non-deposit taking NBFC, was operating appropriately till the start of COVID-19. Due to the unforeseen conditions during the COVID and after, the operating revenue of NBFC started decreasing. Following is the net owned fund of the company during the last 4 years. So they have given what is the net owned funds in the last year: 12 crores, 5 crores, 3 crores. It has now come down to 2.5 crores. Rainbow NBFC appointed Tirthankar and Company as their statutory auditor for the year 22-23. Rainbow NBFC was involved in refinancing of the accounts payable of other companies. So it was basically dealing with accounts payable, that is paying accounts payable on behalf of the company on the due date and allowing additional credit period by charging interest. Now, to test the understatement in existence or valuation of the accounts payable, Mr. Avinandan, the engagement partner, decided to test record and refinance accounts payable on a sample basis. He also decided to verify the refinance accounts payable against the signed contracts. Mr. Abhinandan did not identify any misstatements. So this was in regards to accounts payable. Next, while performing the audit procedures in the month of March 23 itself, it was noticed that Mr. Abhinandan, senior sales manager from Rainbow Non-Bank, agreed to refinance accounts payable of Opal Stones India Limited. But on the due date, he issued payment to his personal account instead of issuing payments to the accounts payable of Opal Stones India Limited. The matter was flagged to him by the audit committee. So instead of paying to accounts payable of Opal Limited, he instead issued payments to his personal account. An amount was subsequently recovered. Due to this, Opal Stone had to pay an additional amount of 4 crores over and above an amount of 25 crores embezzled by the senior sales manager. As Opal Stones had to shell out extra funds due to the above, it was proposing to file a suit against the company. However, the negotiations were still going on between two companies to settle the matter. There was no disclosure in the financial statement regarding this negotiation. Now, no other observation identified Mr. Abhinandan. He is considering to express an unmodified opinion in the above situation. He also approached EQCR Engagement Quality Control Reviewer to review the working papers and documentation. Fine. So let us go through the questions. On the basis of the, you are required to choose the most appropriate answer. Question number 1. While reviewing the working papers of Abhinandan, the Engagement Quality Control Reviewer identified that audit procedures for understatement in existence or valuation of accounts payable refinance is not relevant. So he's saying that the test procedure that we use is not relevant. However, Abhinandan did not understand the comments provided by EQCR. Kindly guide Abhinandan with respect to relevance of audit procedures by selecting appropriate option. So they are asking you, what do you mean by relevant audit procedure? So here they say relevance deals with logical connection with or bearing upon the purpose of the audit procedure. So if the purpose, what is the purpose to obtain psi? If it can help us obtain psi, the procedure is relevant. Where appropriate, the assertion under consideration. In the current case, testing of account payable by the following audit procedure will be relevant for testing the overstatement in existence and evaluation of accounts payable. So see, the procedure that we are applying, it will definitely help us in understand whether there is overstatement, because if we are checking the existence and valuation. So valuation understand, we need to know whether they have overstated. So yes, this procedure will help you in understanding the overstatement. Relevance logical connection with bearing upon the purpose of audit procedure where appropriate, assertions under consideration. In the current case, testing payable will give comfort and completeness on valuation but not an existence. See, these procedures will help us to identify whether that accounts payable are into existence. So this is not relevant. Next, they are saying relevance of information to be used as evidence, and therefore audit evidence itself is influenced by source, nature, circumstances under which it is obtained. So they are in general saying what is it, so not relevant to the case at all. Relevance of evidence is increased when it is obtained from independent sources. So again not relevant. So answer here is quite evidently A. Next, question number 2. During the review of Mr. Abhinandan's working paper, external conformity and quality control reviewer observed that Rainbow's non-bank limited's performance was subpar, with the net owned fund standing at 2.5 crores. So the performance was subpar. EQCR believed that Mr. Abhinandan was expected to include the net owned fund in the auditor's certificate for the year end. Definitely we have to include the same. However, Mr. Abhinandan disagreed. Can you please provide guidelines? Do we have to provide the same? Yes. Every NBFC required to submit a certificate from statutory auditor that it is engaged in the business of NBFC required to hold a certificate of registration and is eligible to hold it. Certificate of reference to the position of the company as on the end of the year. So we are definitely supposed to have this. So answer here is again A. So I'm not reading the other points since the answer is very evidently A. Regarding the issue of embezzlement of the senior manager, what is the most appropriate compliance? See here, he was embezzling the money and embezzlement was greater than 1 crore. If you recollect 143.12, if it is greater than 1 crore, we need to report to the audit committee, the management, then we need to the central government. So here, as per section 143.12, we will have to, if the auditor in a company in the course of the performance of duties has reasons to believe that an offence of fraud which involves or is expected to involve individual an amount of rupees 1 crore or above is being or being committed against the company by its officer, the auditor shall report the matter to central government. Here in C point is they're saying if an auditor of company in the course of performance duty as statutory auditor has reasons to believe which involves and expected to involve fraud rupees 10 crores. No, we are talking about 1 crore and 143.12. They said if the fraud is greater than 1 crore, we'll have to report. So your answer is going to be B. Question 4. Considering the over materiality of around 2 crores, EQCR believes that Abhinandan should not issue a unmodified opinion. Obviously, we have identified misstatements and they are saying materiality is 2 crores. Mr. Abhinandan argues that he has not identified any misstatement. To guide Mr. Abhinandan appropriately, write which of the following options are appropriate. Next, let us see point number A. If the auditor has expressed unmodified opinion on the financial statement, then the auditor shall describe basis of opinion section the reasons of any other matter which the auditor is aware. If we give unmodified, why do we need to give all these reasons and basis for opinion? No. Next, if there is a material misstatement in the financial statement that relate to non-disclosure of information that should be disclosed. So, if there was a case going on which had to be disclosed, then the auditor shall discuss with the non-disclosure with TCWG. Where the impact of non-disclosure is material but not pervasive, auditor should issue a qualified opinion. Yes. When evaluating outcome of litigation, auditor should record in the audit report interest and relationship of management that may create threat in litigation. No, we are not supposed to report anything as such. If the auditor has expressed unmodified opinion along with emphasis, the auditor shall describe emphasis of matter para section reasons for any other matter first which auditor is aware that would require modification. If we require modification, when we give modified opinion, we cannot express in an emphasis. So here again the option B is the correct answer. Last question. Noticing that issue, Mr. Abhinandan reported the fraud to audit committee within 2 days. So if fraud is greater than 1 crore, we'll report it. Seeking their reply and observation within 45 days. However, neither the audit committee nor management replied till 45th day. Kindly guide the auditor is expected to do in the case when he is not received any reply. So if he does not receive any reply, he will have to go to the central government within 15 days and report it to the central government that he has not received any such reply. So here the answer is C. In case the auditor fails to get reply or observation from the board or the audit committee within a stipulated period of 45 days, he shall forward his report to the CG along with a note containing the details of the report that was earlier forwarded to the board and audit committee for which he has not received any reply or observation. If he had received reply, he would have given the reply as well as his comment, but since no reply has been received, we will state that no reply has been received here. So this was our integrated case study. Let us move ahead with our discussion of independent MCQs. So you are the tax auditor of a manufacturing firm. Net profit before tax of the firm is 15 lakhs arrived at after debiting all expenditure including salary to partners. The partnership deed of the firm stipulates payment of salary to the working partners. So how much they have paid? So their profit so far is 15 lakhs. It's after debiting the expenses and salary. So the salary is per month. So here the salary is 12 lakhs per year. 12 lakhs and this will be 6 lakhs, which is the correct. So if you know how much salary can we, in case of a partnership firm, up to first 3 lakh rupees, we can give 1,50,000 rupees or 90% of 3 lakh, which comes to 2,70,000 rupees, whichever is higher. So here it comes to 2,70,000. Now, after this 3 lakhs, so for example, what is the profit before debiting this? 15 lakhs plus this 12 plus 12 plus 6. So comes to how much? 15 plus 12 plus 12 plus 6, 45. But out of 45, we have already provided on this 3, so 42. So on this 42 we can give 60%. So on 42 lakhs if we provide 60%, it comes to 25 lakhs 20,000. So overall it comes to, if I add 2 lakhs 70,000, 27 lakhs 90,000. But how much salary have they provided in the books? 12 plus 12 plus 6 comes to 30 lakhs. How much can we give? 2790. So if I deduct 2790, how much excess they have given? 2,10,000. So here answer will be B. The partner salary is not fully allowance and admissible amount up to 2.10 lakh rupees is to be reported. So this is based on your knowledge of your tax. Next, moving ahead with point number 7. So CF Vishnu is auditor of a company having 15 inventory locations in the country. In the view of multiple locations and logistics issue involved, he decides not to attend the physical verification count process of the company. The company management also sends him a digital evidence comprising of the videos of inventory counting process at different locations as on reporting date with the date and time stampings. Besides verifying the inventory record, he also performs alternative procedures like examining the details of subsequent sales or specific inventory item prior to physical inventory counting. Which of the following statement is most appropriate? See, he skipped the inventory counting. See, only if it is not feasible, then we will apply alternative procedure, or else we need to perform the inventory counting. So here the procedure adopted by auditor is not accordance with SA. Which SA are we talking about? 501. An auditor can skip attendance at the inventory counting only when attending is unfeasible. Next, Guru Private Limited uses in-house developed application system for accounting. The auditor observed that the user ID and the password is mandatory to access the application system and felt this is a good control. What type of control is it? IT general, application, detective, preventive. Why? Because there will be no unauthorized access to this particular thing. So this was a discussion about MCQs. Moving ahead with the descriptive questions. Question number 9. Mr. Shreyansh, while performing the audit of Red Rock Silver Stand Limited, which was involved in the phosphorus mining, decided to appoint an auditor's expert for the valuation of environmental liabilities and the site cleanup cost. Red Rock and Silver Sand Limited appointed Mr. Sheetal. So company appointed Mr. Sheetal, an independent expert, for this engagement. For the last 5 years, manager had been reappointing Mr. Sheetal. Mr. Sheetal calculated the environmental liabilities pertaining to completed mining sites and the sites which will be discarded in the future, and provision for the site cleanup cost. This provision was accepted by the management. Now Mr. Shreyansh, after performing the inquiries with the management, was of the opinion that objectivity of the independent expert cannot be questioned just because he was appointed by management as their expert. Hence, there is no need to raise question on the objectivity of Mr. Sheetal or his work performed or the company. However, the partner was of the opinion that the audit team needs to evaluate the objectivity of an expert engaged by the entity, irrespective of the fact that he was appointed as an independent expert. Kindly guide the audit partner and Mr. Shreyansh with respect to the requirement pertaining to the objectivity of the management expert. So, objectivity of the management expert is contained in SA 500. So, let us go to the answer here. Okay, so whenever you are using the work of a management expert, it is dealt with in SA 500. We will evaluate the objectivity, integrity, independence of that particular expert. We will evaluate his competence and capabilities. So as per SA 500, when information to be used to as audit evidence has been prepared using the work of management expert, the auditor shall, to the extent have regard to the significance of the expert work for the auditor's purpose, he shall evaluate the competence, capability and also the objectivity. See, now there are a lot of threats to the objectivity. For example, if you recollect, there are multiple threats: self-interest threat, advocacy, familiarity, review threat and intimidation threat. if there are such threats, they should try to apply a safeguard. So a safeguard may reduce such threat and may be created either by external structures or by management experts work environment, for example quality control policies. Although the safeguards will not be able to eliminate these threats, all the threats to the management expert, threats such as intimidation may be of less significance to an expert engaged by an entity than expert employed by the entity. So what they're saying is there may be some threat, we may try to eliminate them, but we cannot, we may try to apply a safeguard, but we cannot eliminate completely. Now, because threat to objectivity created by being an employee of the entity will always be present, an expert employed by the entity cannot ordinarily be regarded as being more likely objective than other employees of the entity. So here they are saying what all we need to evaluate. In this particular company, they have been reappointing Mr. Sheetal since a long time. For this engagement, the team was of the view that objectivity of individual cannot be questioned just because he was appointed by the management as their expert. Now, hence the audit team should evaluate the objectivity of the expert as a threat to objectivity created by being an employee of the entity will be present. Since he is an employee, there will always be a threat. An expert appointed by the entity cannot ordinarily be regarded as being more likely to be objective than the other employees of the entity. As a result, audit partner is correct in his view that objectivity is compromised and we cannot use the work of this particular expert here. So this was your question number 9, which was talking about SA 500. Question number 10, dealing with SA 250. Now CA Paras has been appointed as the Chief Financial Officer of Prashant Limited. In his role, CA Paras is tasked with the responsibility for ensuring that the company's entities' operation are conducted in accordance with relevant laws and regulation. As a part of his duty, CA Paras is emphasizing the importance of adhering to all the laws and regulation that could impact entity-specific disclosure in the financial statement. Additionally, he is focusing on compliance with laws and regulation that dictate the appropriate financial reporting framework. Now, CA Paras is highlighting the significance of avoiding any non-compliance, as certain laws and regulation may impose those penalties in the event of violation. Now, Paras wants to implement policies and procedures in an entity that can assist in prevention and detection of non-compliance with law. Now, they are asking you help CA Paras by citing examples of such policies and procedures. So, they are asking you what policies we can make so that we can comply with the laws and regulation. So, SA 250, consideration of laws and regulation in audit of financial statement. Here, they are saying for this purpose, management may apply following procedures. Firstly, monitoring the legal requirement and ensuring that operating procedures are designed to meet this requirement. So we'll have a monitoring the legal requirements. So what legal requirements are applicable? We will ensure that procedures are built in such a way that we comply with this. Second, instituting and operating systems of internal control. So if we have well designed internal controls, we will comply with the same. Developing and publishing and following a code of conduct. So this will again help that employees are kept into a moral check, they follow the code of conduct, there will be no non-compliance of laws and regulation. An employee should be properly trained and should understand the code of conduct. Only if they are trained and know what are the laws and regulation, they will not comply. Monitoring compliance with code of conduct and acting appropriately to discipline employees who fail to comply. See, why are we emphasizing so much on code of conduct? If there is an employee who is not following code of conduct, there is a high probability that he may non-comply with the laws and regulation. Engaging legal advisors who may assist us in monitoring the legal requirements. And lastly, maintaining a register of significant laws and regulation which are applicable to the particular entity, considering what is applicable in the industry. So these are the procedures that we can develop. So this was about SA 250. Next, Caro. So they have framed a good question here, a non-repetitive question which we have not done earlier. So I would suggest go through this particular question here. CAF has been appointed as statutory auditor of XYZ Limited for the year 2022-23. XYZ has one subsidiary named AT Private Limited, whose statutory auditor is CAB. So CAF is auditor of holding and CAB is auditor of subsidiary. Now CAB, that is auditor of subsidiary, issued a qualification in CARO 2020 for 80 Private Limited stating that short-term funds were utilized for long-term purposes. Now when consolidating the financial statements, CAF decided to include aforementioned qualification in the auditor's report on the CFS for the financial year 22. Management of XYZ Limited argued that CAF is not obligated to take into account and report on qualification by CAB in the audit report of subsidiary company in the consolidated financial statement. Discuss the reporting requirement as per CARO 2020. So now if you recollect CARO 2020, paragraph 2 said that CARO is not applicable to consolidated financial statement except for clause 21. What does clause 21 tell you? So clause 21 of para 3 of CARO 2020 says that if you are an auditor of a holding company, so the clause 21 mandates auditor to comment whether there are any qualification or adverse remark in CARO reports of companies included in the CFS. If qualification or adverse remark exist, auditor is required to provide details of the companies and also the paragraph number of the CARO report containing this qualification. So if I am auditor of holding, so example CAF is auditor of holding. If CAB has provided any adverse or qualified remark in CARO of the subsidiary company, then auditor of holding company in his CARO in clause 21 needs to give a reference to that company. Also state the paragraph number under which adverse or qualified remark have been given. So definitely CAF has a responsibility here. Considering the above provision, CAF, the auditor of XYZ Limited CFS, is required to do the follow these steps. Under clause 21, CAF must include a comment in the CFS statement that audit report regarding whether there are any qualification or adverse remarks of the companies included in the CFS. He will have to incorporate the qualification that are given by CAB. CAF should incorporate the qualification made by CAB regarding that the short-term funds have been utilized for long-term into the auditor's report in the consolidated financial statement. He will also have to mention the paragraph number. So obviously there is a reporting responsibility from the end of CAF. So this question was about CARO 2020. Moving ahead with question number 12. XYZ Limited, involved in the hospitality business, appointed Charan and Karan Associate as the statutory auditor for the financial year 22-23. Management of XYZ Limited, while drawing up the financial statement for the said period, decided to add the following statement after the statement of cash flow as supplementary information to be presented with the financial statement. No specific mention or labels were added to the statement to present that this is supplementary information. So it looks like it is an integral part of the financial information. Now they said what was the booking in the previous year, average revenue. They have given reference to revenue from operations and booking ratios. Kindly guide the audit team regarding the requirement of SS 700 with respect to the supplementary info. So now what is the requirement? Now, if supplementary information is integral part of the financial statement, then auditor will have to issue an opinion on the same. But let us say if it is not an integral part, we will request management that you give it in such a way that it does not look like it is an integral part. So we will request management to change way of presentation. Now two cases, management changes or the management refuses to change. If management changes, nothing like it, but if management refuses to change, then in the auditor's report we will have to mention that this supplementary information is unaudited, that we are not expressing any opinion on this supplementary information. So once again, if it is integral, we will give our opinion on this supplementary information. If it is not integral, then we will request the management to present in such a way that it does not, users do not misunderstand it that we are expressing an opinion on this. If they change the way of presentation, very good. But if they do not change the way of presentation, it still looks like, this supplementary information is part of financial statement and auditor is expressing an opinion, then in that case we will have to include in our audit report that we do not express on any opinion on the supplementary information, those are unaudited. So now in this case it is quite evident that it is looking integral, because here they said no specific mention or labels were added to statement to present that it is supplementary information. Here they have also given a lot of references, so it is quite evident that it is an integral part. So what they say here is that if it is an integral part, then it shall be covered by the auditor's opinion. But however, if it is not an integral part, the auditor shall evaluate whether such information is presented in a way sufficiently and clearly differentiates from the audited financial statement. If it is not the case, we shall ask the management to change how unaudited supplementary information is presented. If management refuses to do so, auditors shall identify unaudited supplementary information and explain that auditor's report that such supplementary information has not been audited. Now, the evaluation of whether unaudited supplementary information is presented in a manner could be construed as covered by the auditor's opinion includes, for example, what information is presented in relation to the financial statement and audited supplementary information, and whether it is clearly labeled unaudited. So whether we have clearly labeled this as unaudited. This is what they have written case specific. Now they're saying what we can ask management is to remove the cross references. What do you mean by remove the cross references? Here we have given the cross references, that is note number 828. So it gives you an somewhere in it is represented in such a way that it is a part of financial statement. So ask them to remove this, or at least put a note there that this is supplementary information and these are unaudited, but there is no note here as such. So if the management refuses, auditor shall identify unaudited supplementary information and explain in the auditor's report that supplementary information has not been audited. So this was our discussion about SA 700, supplementary information. So now in the financial year 22-23, MOX Limited faced extraordinary event, that is earthquake, which destroyed a lot of business activity of the company. These circumstances indicate material uncertainty of the company's ability to continue as a going concern. Due to such event, it may not be possible for the company to realize its assets or pay liabilities during the regular course of business. The financial statement and the notes to accounts of the company do not disclose this fact. What kind of opinion the statutory auditor of MOX Limited issue in such circumstances? My friends, if there is going concern is inappropriate, if the financial statement do not disclose the same, we will have to give an adverse opinion, because if going concern is inappropriate, we have to get everything from book value to realizable value, which they have not done. So accounting has an issue. Then we need to convert everything from non-current to current, so presentation also needs to be changed. They also need to give a disclosure. So here the matter is material and pervasive, hence we will have to give an adverse opinion. So let us check the answer. In the present case, we will have to give an adverse opinion. So we will frame an adverse opinion. We will also write about the basis for adverse opinion. So this was our question number 13A. Next, how does the inclusion of emphasis of matter para report differ from the disclosure of key audit matter? So all you need to write here is a distinguish between both. So you just have to explain what is a key audit matter. Key audit matter is the matter which is most significant in the auditor's judgment and communicated to those charged with governance. Now, what is emphasis of matter para? A matter appropriately presented or disclosed in the financial statement is fundamental to the user's understanding. So, point number 1, they are explaining nothing but the meaning. Next, matters that are key audit matters in accordance with 701. Auditor's judgment fundamental to the user's understanding of the financial statement. In such cases, communicating a key audit matter in accordance with 701, the auditor may wish to highlight or draw further attention to its relative importance. Now, communicating a key audit matter is nothing but what? Additional information. So here all they have explained is what is a key audit matter and what is the emphasis of matter para, which we have already covered in the lecture. So I am not taking you in detail for this. You can just briskly read through, which we have written in the lectures as well. Next, audit of consolidated financial statement. Subahu Limited is an investment company preparing the financial statement in accordance with Ind AS. The company obtains funds from various investors and commits its performance for fair return and capital appreciation. to its investors. So basically here this particular company is an investment company. If you recollect your Ind AS 110, consolidation is not applicable to investment companies. So all they have to do is they will have to show their subsidiaries at a fair value. Let us read through the question. During the year under audit, it has been observed that company invested 25% in S1, 50% in S2 and 60% in S3, the respective share capital of the investee company. When checking the investment schedule of the company, as an issue cropped up as to whether there would arise any need to consolidate accounts of investee companies to those of Subahu Limited in accordance with section 129 of the Companies Act, which contains no exclusion from consolidation. So, if you are an investment company as per Ind AS 110, you need not do consolidation. You need to show all these companies at fair value. However, you need to comply with the provision of Schedule 3 of the Companies Act. So, though consolidation is not required as per Ind AS 110, we need to make sure at least consolidation as per the requirement of Schedule 3 of the Companies Act has been complied with. So, this was our consolidated financial statement. Moving ahead, Audit Committee and Corporate Governance. Now, AB Limited is a listed entity ranking in top 500 entities as per the SEBI for the financial year 22-23. You are required to comment in the following circumstances in the light of provisions of SEBI listing obligation and disclosure requirement regulation 2015. Now, the board of directors of AB Limited comprises of 5 directors. See, if you are a part of top 2000 listed entities, then you need to have at least 6 directors. However, they have appointed only 5. So, as per the SEBI LODR, if you are a part of top 2000, you need to have how many directors? 6. However, they have 5. So, this is a non-compliance. Next, the independent directors did not hold any meeting in the financial year without the presence of non-independent director. They should meet at least once without the non-independent directors. Again, a non-compliance. Risk Management Committee of AB Limited devised a policy on board diversity. See, they cannot make a policy on board diversity. They can make policies related to risk management. So here it was hold at least one meeting. Here they cannot make anything related to board diversity. Who can make? It can be done by Nomination and Remuneration Committee instead of the Risk Management Committee. So again, a non-compliance. The chairperson of Stakeholder Relationship Committee of AB Limited is an executive director. Here he should be a non-executive director. He cannot be a executive director. Again, a non-compliance. Lastly, AB Limited submitted quarterly compliance report on corporate governance for the quarter ending 30th September on 25th. See, after quarter, we need to give this in 21 days. So, when does the quarter end? April, May, June. This is the second quarter, July, August, September. You need to give it within 21 days. But however, here they have given on 25th. So, this will be incorrect. Again, there is a non-compliance. So, in all the above cases, there was a non-compliance. So, this was a question number 15. So, question number 16. SPS Limited, a listed entity, constituted various committees instrumental in the robust corporate governance practice. As necessitated prevailing legal and the regulatory obligation, over the course of the financial year, several financial matters emerged, which were deliberated upon during the respective committee meetings. Now, we need to tell them which identify the names of committees which would likely be discussed these issues along with the reasons. So, complaints and requests received from non-receipt of refund amount relating to the subscription, issue of rights for company and action taken were reviewed periodically. So, which committee will cover this discussions? So, it will be Stakeholder Relationship Committee. The Stakeholder Relationship Committee will cover these things. Second, various measures have been taken to enable security holders to claim hitherto unclaimed dividends due to the transfer of Investor Education Protection Fund were reviewed periodically. Again, this will also covered by Shareholders Relationship Committee. Third, upgraded evaluation of the board. So here also we discuss, so board diversity and everything was not done by risk management. Who will cover this related to board? The Nomination and Remuneration Committee. And lastly, omnibus approval for transaction with the related party. Who will cover this? The audit committee. So this was your SEBI LODR. Next, audit of banks and insurance companies. PQS and Associates, one of the joint auditors of KNO Bank for the year 22-23. While auditing KNO, they are analyzing industry data to NPA in selecting the public sector banks as part of risk assessment. So they saw there is gross NPA and net NPA, ratios of NPA to net advances. In the above context, they are asking what do you mean by gross NPA and net NPA? See, it is like gross depreciation and net, so gross assets, net assets. What do you mean by gross? So gross is nothing but the opening NPA. Then what you will do is add NPAs during the year less the accounts which are not NPA, and hence eventually what you will get is net NPA. So gross NPA is the opening balance of increased NPA is increased by fresh NPA during the year and reduced by upgradation, recoveries and write-off during the year. Now, net NPAs are arrived after deducting the amount of the total provision held against NPAs. So this is nothing but net NPAs. Now, second question what they are asking is, as auditor of KNO Bank, what inference would you draw by comparing the ratio of net NPAs to the advances with the other public sector? So if you see, the ratio of net NPAs to net advances is higher in case of KNO. So in other banks it is 1.72, 2.34, but we have almost close to 4%. So somewhere what it shows is that they might not have done adequate provisioning here. So net NPAs to advances ratio is higher in case of KNO Bank as compared to other public sector bank. It shows that there is a risk that bank could not have made required provision in accordance with RBI guidelines. Higher net NPAs to net NPA advances ratios indicate probability and risk of under provisioning here. So we understood two things: what is gross NPA and net NPA, and if there is a higher ratio of net NPAs to net advances, it means they might have not have done provisions. Next, question number 18. CS Sundaram is an engagement partner conducting a statutory audit of a nationalized bank. The bank operates on the CBS platform, and the identification of NPA system is based in accordance with the RBI guidelines on asset classification. He wants to be assured of the satisfactory operation of internal control in this respect. He wants to be sure that there exists internal control in the bank which not only prevents and reduces the risk of loan asset become NPA at the initial stage, but also sends out timely signals to the banks subsequently. He is putting considerable importance on effective credit appraisal due to their role in preventing NPA slippages. While carrying out a walkthrough of the internal control advances of bank, especially in the areas of credit appraisal and credit monitoring, identify 4 specific controls which you may be looking for. So here they are asking you what are the 4 controls you may be looking forward for in case of credit appraisal and credit monitoring. So what you can use is, we can use third party source data to do credit analysis, if that particular party will be in a position to pay. So for comprehensive due diligence at the sanction stage itself to mitigate the risk of account of misrepresentation of fraud. So we can use third party data sources. Second, you can have a classification of accounts into SMAs. See, before the assets turns NPA, if the party has not paid on the due date, then in that case we will classify that account as SMA 0. If they have not paid up to 30 days, SMA 0. 31 days to 60 days, we classify this as SMA 1. Then 61 days to 90 days, if they have not paid, we will classify them as SMA 2. So this classification may also help in early detection. Then we can use institution of comprehensive automated early warning system in banks which triggers that stress. So if there is any stress or something for NPS, this particular system will trigger it. And a reporting of repayment behavior of borrowers in their loan to the credit information companies, and inclusion of this information in the credit appraisal itself. So if a person has taken a credit card, whether he's repaying on time, whether he's not repaying on time, so all this credit information can be collected so they can understand at the early stage itself whether a loan should be sanctioned or not. So these are the internal controls that we can establish here. Next, Plus Insurance Limited agreed to insure a large commercial client. Due to the size of its client's operation, there is a potential risk that it could suffer substantial loss. It would be financially difficult for Plus Limited to pay the entire claim itself. To spread this risk, it contacted a Minus Insurance to cover the portion of the risk. So basically what they are doing is reinsurance. Minus, because it on the condition that it receives a portion of the premium the client paid to Plus Insurance. Briefly explain the insurance arrangement and its types. So it is nothing but reinsurance. There are two types of reinsurance: facultative reinsurance, treaty reinsurance, which we have already covered. Please, you just have to read through this. We have already covered this. This is nothing but a reinsurance, facultative. So that is, we will do case to case basis, and treaty, we can have one single treaty for all the types of reinsurances. Moving ahead with question number 20. Now, during the tax audit of a company, it is noticed that the company is deducting ESI and PF from the remuneration of its employees in accordance with the requirements of the applicable laws and regulation. Contribution are as stated below. So for ESI, this is employee contribution. For PF, employee. Here it is for ESI, employer contribution. For PF, employee. So they stated the amount. They have stated the due date for payment, and they have stated the actual date of payment. Now they are asking us, how do we disclose under this form 3CD? See, for this there are two clauses here. One is clause 20B, one is 26B. See, 20B says whatever is the employee contribution, auditor just has to disclose. So we need not give any opinion whether the same has been paid or whether the same has been deposited, not deposited. All we need to say, okay, what was the employee contribution? So we will have to disclose the employee contribution under 20B. 26B says, so for example, all the employer's contribution, that is expenses, will be allowed provided that is paid before filing income tax return. So if they have paid this before the income tax return, it will be allowed as an expense or it will not be allowed. So employer's contribution, obviously, so though this is 14th of April, 18th of April, it is much prior to filing the income tax return, and hence this particular amount will be allowed. So this we will quote under 20B, and this part will go under 26B. Next, moving ahead with the next question. Liabilities of auditor. So PKS and Associate are auditors of a listed company, have an aggregate debt burden of around 10,000 crores. The company defaulted due to the failure of corporate governance across all its groups and window dressed its financial statement. Further, upon a receipt of a report of the Registrar of Company in this regard, Ministry of Corporate Affairs directed Serious Front Investigation Officer SFIO to investigate into the affairs of the company and subsidiary. SFIO report highlighted failure on part of audit firm to report the fraud in the company to the central government, siphoning off and diversion of funds, and many other lapses, including collusion and fraud by the auditors themselves. MCA filed a petition with NCLT for removal of auditors, and the final order was passed by NCLT highlighting collusion between the management and the auditors. Comment on the above situation with reference to the consequences of auditor. So this is nothing about 140 subsection 5, removal of an auditor in case of fraud. So we will have to make an application to the central government. So we will state the provisions of section 140 subsection 5. Also, since they are asking you about the consequences, we'll also have to write what is going to be the penalty. So what is 140 subsection 5? The auditor, whether individual or firm, against whom final audit has been passed, shall not be eligible to be appointed as an auditor for any company for a period of 5 years from the date of passing of the order, and shall also be liable under section 447. Further, penalty will be, the auditor shall be liable for a penalty of rupees 5 lakhs for failure to report fraud to the central government. Because if you recollect 143.12, in case of a listed company, the penalty is going to be 5 lakh rupees. If it was not a listed company, the penalty would have been 1 lakh rupees. Since this is a listed company, penalty will go up to 5 lakh rupees. So 140 subsection 5 and 143.12, two sections they are talking about. Next, Messrs. Manidhari and Company, Chartered Accountants, have been approached by Raju Limited, a company engaged in iron and steel manufacturing industry. the company is facing following operational issues. Penal interest for the delayed payment to the overseas vendors despite enough cash flows. So we have enough cash flows, but we are not paying on time, and hence we are paying penalties. Despite regular production and enough inventory, delays in the shipping in the final goods to the customers, leading deteriorating the vendor rating. Now, as a partner of Manidhari and Company, through detailed discussion with the senior manager of Raju Limited, we have concluded all these delays are because of long decision making cycles in the company. As a consultant of the company, what would you recommend, management audit or operational audit? So here management audit is audit of management, operational audit is audit for management. Here who's making delays in decision making? The management. So we want to see where management is making the mistake. Hence, this is not audit for management, it is audit of a management. Hence, here what we will be performing is a management audit. Next, question number 23, due diligence, investigation and forensic audit. CA Kushal has been appointed as an investigator of XYZ and Associates. While undertaking the assignment of investigation, the subordinate staff of CA Kushal inquired about the following issues: whether investigator is required to undertake cent percent verification approach or whether he can adopt selective verification. So obviously it will depend on case to case basis. If we are verifying cash balance, so if the investigation is for cash, we might have to verify 100%. But it is for the whole profitability profitability of the whole financial statement, then we might not take 100% verification. Second, whether an investigator necessarily requires assistance of an expert. So it may depend from case to case basis. In few cases, yes, he may require. In case he wishes to take an assistance of an expert, he must obtain a consent from the client. Lastly, whether he is supposed to retain the working papers. Definitely the way he retains the working papers his audit, he will also have to retain the working papers of investigation. The question is also covered in our JKC textbooks, which we have already discussed. Moving ahead with the next question. Now, CM Manpreet was selected as a technical reviewer by the Quality Review Board to review the quality of the audit performed by XYZ and Company. Before starting review, CM Manpreet approached you to understand the key stages that are typically involved in conducting quality review. Assignment: from the initiation of the review to the final evaluation and decision making. Kindly outline the key stages that are typically involved. So basically here they are asking the all the stages that we have discussed during the lectures. Like what we discussed in the peer review, they are asking you all the stages of quality review. So please go through all the stages that we have discussed. I am not wasting your time here by discussing all the points which are already covered. We will keep our discussion restricted to few new questions which they have added in the RTP. Question B. What are the consequences if the Quality Review Board notices major non-compliance with the requirement of the standard on quality control and standards on auditing and accounting standards? So if they have any non-compliance, what we can do, also we have covered in our textbook. They can give a recommendation to ICAI, make recommendation to the council, advisory issue and guidance to AFUR. So here we have covered all these things. So both the questions 24A and 24B we have already covered in the lectures. Question number 25, comment on the following scenario with reference to the CA Act. Here the statutory audit of Arihant Limited for the year 21-22 was done by CA Acharya and was in existence since 2010. The relevant extract from the books of accounts of Arihant Limited. So here they are showing share capital, reserves and surplus, which is negative, provision for the audit fees. CA Nemi appointed. Who was the auditor so far? CA Acharya. Now who is appointed? CA Nemi as the statutory auditor for the year 22-23. In spite of the fact that on the date of acceptance by CA Nemi, audit fees of CA Acharya was unpaid. So if you recollect clause 8, we must communicate with the previous auditor in writing. If the unpaid fees are not paid, we will not accept. But the Council General guidelines have given us an exception. If the unit is a sick unit, you can accept the audit even if unpaid audit fees are not given. In this particular case, it is a sick unit. What is a sick unit? Where the accumulated losses are more than the net worth. So here the accumulated losses are more than the share capital. This is a sick unit. Then in this particular case, the new auditor can accept, no problem in this. Next, so in this case, CNME is not guilty. Last question, CA Sumti is practicing chartered accountant having office in Mumbai. CS Sumdi is a owner of a domain of CapNet. In order to generate additional revenue, CS Sumdi sold this domain name to XYZ Limited for earning a royalty of 2,25,000. One of the directors of XYZ Limited contended that CS Sumdi has violated the code of conduct. CS Sumdi responded that there is no violation. As per clause 11 part 1 of the first schedule, if we engage in any occupation other than CA, we need to obtain a permission from ICI unless all the occupation that we are entering into are mentioned in the general resolution. Selling of domain spaces is not mentioned in the general resolution, hence we will have to obtain a specific permission. Without obtaining specific permission, if we enter into this, we will be guilty of misconduct. Hence in this particular case, CS Umti will be guilty of misconduct. So with this, we are done with our discussion of RTP, that is November 2023. So thank you very much, my friends. With this, we put an end to our discussion of RTP November 23 for the subject of audit. If you have any doubts, please get in touch with us. You can post your messages, you can post your doubts on the WhatsApp helpline session. We have a free 24-hour WhatsApp helpline session. You can post your doubts there. We'll be happy to help you. I hope you have understood the RTP and gone through all the questions of RTP here. Thank you very much.